Welcome back to In Conversation with Lone Star Pace. I'm thrilled today to be joined by three experts who bring complementary perspectives on the economy and commercial real estate. So we're very excited to welcome Mark Zandi, who's the chief economist at Moody's Analytics. And many of y'all have heard of Mark. He's one of the nation's most respected economic forecasters. We've got Doug Prickett, a good friend of ours, a principal at CRE Tactics and a counselor of real estate. And Doug has many years of experience helping owners and investors navigate all of their real estate decisions. And finally, we have our very own Glenn Silva, who is the DFW chair of the Counselors of Real Estate and the COO for Lone Star Pace. So thank you all so much for joining us. Today, we're going to be exploring the state of the U.S. economy, the outlook for the remainder of this year and next year, and what all of that means for commercial real estate. So I'm going to start with you, Mark. You've said the U.S. could possibly be headed toward a recession, and you've been watching all sorts of metrics, consumer spending, employment growth, construction and manufacturing, and even with the possibility of interest rate cuts, you've suggested that that may not be enough to stabilize the economy. So what other levers could realistically be pulled to sort of change that trajectory in your view?
Well, Olivia, thank you for the opportunity. It's good to be on with Doug and Glenn. I appreciate that. Yeah, I think the U.S. economy is struggling. You can see it in everything from GDP to consumer spending, manufacturing, construction. They're weak, and most recently, in terms of job creation. Job creation has come to a near standstill. So we're not in recession, but it feels very uncomfortable. And of course, inflation is starting to pick up as well. It's on the high side of anything that anyone would feel good about, and it's moving in the wrong direction. So yeah, I think the economy's got some struggles here, and one other thing I'd say is that when the economy is struggling like this, it's vulnerable to anything else that could go wrong. And goodness knows there's a lot of different things that could go wrong. Now, what levers could be pulled? I think the Federal Reserve is going to respond to all this by cutting interest rates. The Federal Reserve Fed Chair Powell has made that pretty clear in the Jackson Hole speech that the Fed feels like it's going to start cutting interest rates in this month in September when it meets, and then steadily lower rates, and that should be helpful. If you have a credit card, you'll benefit from those lower rates. They're awfully high, but they'll come in. If you're a small business person, you'll benefit from the lower rates because the prime rate is tied to the federal funds rate target. So, I don't think it's a game changer, but it should on the margin. And then, of course, there's always fiscal policy, that's tax and spending policy. And in the next fiscal year, which starts next month, Congress and the administration can come forward with another so-called reconciliation bill. This is just a mechanism for passing legislation you don't need a filibuster-proof majority in the Senate. This is how the big beautiful bill was passed in earlier this year, and so we could get another set of tax cuts. For example, there's been discussion about a so-called stimulus check, a check of a couple $1,000s that goes to Americans. And if that were to happen, obviously that adds to deficits and debt, and that's an issue, a longer term issue, but it would help to support spending and help the economy in the near term. So there are some things, some levers, as you say, that could be pulled that will help the economy to help the economy kind of navigate through this difficult period. But I think it's going to be a difficult period.
Absolutely. And you mentioned inflation before. Inflation has been pretty sticky thus far. Where do you see it heading in 2026? And what are the implications for the real estate industry in terms of making long-term bets going into next year?
Inflation is going up. It's higher. It's going to go higher. I mean, just to give you a number to make it concrete, the core consumer expenditure deflator, that's the measure of inflation the Fed focuses on when setting interest rates. That's growing year over year, 2.9%. That's the most recent data through July. For context, the Fed's target is 2, so it's almost a point above what the Fed wants. And it's accelerating. If you go back, it bottomed out kind of the spring around 2.5%-ish, and so it's starting to move north. And it's going to go higher. for two key reasons. One is the tariffs. The tariffs they keep on rising, and the pass through from businesses to consumers will intensify as we make our way through the year into next. And the other is highly restrictive immigration policy that's leading to shortages of labor. We're starting to see, some industries like construction, the construction trades, which are very immigrant intensive, agriculture, manufacturing, transportation, distribution, healthcare, leisure hospitality, retail, all employ, particularly in the South and the West, employ a lot of immigrants. And so, that part of the labor force is under a lot of pressure because of the immigration policies. So that means weaker growth and higher inflation. So just again, to give you a number, I expect inflation by the measure by the core consumer expenditure deflator to kind of peak out year over year sometime next summer-ish, around 3.5%, maybe as high as 4, kind of in that ballpark. And that's despite the weaker economy, which, all else equal, would argue for lower inflation just because of weaker demand. But despite that, the tariffs and the immigration policy means higher inflation. And for real estate, there's a lot of different cross currents. I mean, real estate historically has been a good hedge against inflation. But I think the thing you have to worry about most in the near term is what does it mean for long-term interest rates? Will the higher inflation push up long rates as bond investors work to try to compensate for the higher inflation? So it's hard to know what the inflation means for commercial real estate, certainly in the near term because there are a lot of cross currents.
Absolutely. Well, let's zero in a little bit further into commercial real estate specifically. So Mark and Doug, I'm sure you guys can both probably chime in on this one. How will tighter credit and slowing growth affect the capital stack for commercial real estate projects, particularly around debt service coverage ratios and equity requirements?
Well, I think they've already been, pretty restrictive. I mean, banks in particular are trying to figure out the conundrum of all the debt that they have, and we've had a lot of extend and pretend or whatever you want to call it. But I think the ratios will continue to be pretty conservative until we get through this economic period. I mean, they're very closely tied. And I worry more about fundamentals than I do the debt market. So Mark can probably expand on it, but kind of hitting on what we just talked about, jobs drive real estate demand. And that's one of the big concerns is just the fundamentals that have been pretty good in a lot of sectors are probably at risk. And then you think about, who's most vulnerable. And it's middle tier America is in really tough waters right now. And they drive a lot of real estate demand. So those are the things that are kind of keeping me up at night. Mark, what are your thoughts on the debt?
Well, as you said, I think lenders are going to remain cautious. They have been, since the Federal Reserve jacked up interest rates back now, really almost 3 years ago. We saw interest rates spike, and at that point there was a lot of concern about valuations and the economy. This worry about recession has been with us for at least a couple 3 years. And so I think lenders, the banking system, and regulators have been very, very cautious since that period up until this point in time. And so far there's been I think the commercial real estate market has adjusted reasonably gracefully. I mean, prices are down, valuations are down as a result of the higher rates and the tighter credit. There's some increase in delinquency on the debt, particularly in the commercial mortgage-backed securities market. You can see some increase in delinquency and default. But, in the grand scheme of things, it's kind of held together much better than than I was certainly worried about a couple, 3 years ago. But I do think here we are. Rates are still high. The economy is still very vulnerable. I think lenders are going to remain cautious, and regulators as well are going to remain cautious. So I don't see any significant turnaround here, at least not until, I think you said, Doug, until we kind of get through this period here over the next 6, 12, 18 months.
I was just looking at some reports. one from JP Morgan and the other one from our good friends at MSCI, Real Capital Analytics. And transaction volume is actually improving. It's been improving since 2023. So the volumes, it's not, off the charts, but it's going in the right direction. And cap rates, more importantly, seem to have flattened. But the spread between the treasury and the cap rate is really tight. And I think that's the concern of a lot of people is like, whatever rates do, those cap rates are not as likely to move around as much. They don't move lockstep with treasuries, which we've proven on several cycles now.
So Doug, it's interesting you talk about how we've seen a uptick in transaction volume. Is that happening in sort of lockstep with investor sentiment? Are we also seeing investor sentiment improve? Are owners and developers sort of shifting their strategy in anticipation of either interest rate cuts or perhaps an economic slowdown, the type that Mark is forecasting?
I mean, investors want to deploy capital. And they have an appetite for that. It really depends on your sector, but it's been really hard to buy, to make deals pencil, especially in the existing product. Development is on the sidelines right now, which is probably the real opportunity. Developing into this massive shutdown of pipeline for apartments and industrial. There's a lot of my friends in the institutional world they would love to start developing, but their capital sources are risk off on development. So just depends on your sectors. I mean, retail's the darling right now. It's getting the best risk adjusted return. But if we do have a slowdown, you want to be careful what kind of retail you're in. So the really high end luxury and the discount stores, they tend to do okay in a slowdown. But everybody in the middle, needs based does well too, grocery anchored and such. But yeah.
Interesting. And you and I have talked a lot about how at this point in time, it's really going to be all about sort of the innovation within your capital stack, the layering of different incentives and debt and equity. Do you want to expand on that a little bit?
That just speaks to creativity. And so, there's opportunity zones have been around for a while, and that helps you bring, capital that wouldn't necessarily be investing in a particular area. And that's been very successful. TIFs have been around forever, which is tax increment funding for financing, and those are around. But there's some newer ones, and Glenn could actually opine. Our gracious host here is in the PACE world, and that's some of these are just misunderstood or not understood, and they're not that difficult. But I think that's one of the great opportunities is this PACE. It acts kind of like a mezzanine layer, but it's much more friendly.
Glenn, I mean, yeah, tell us more about how PACE could possibly be inserted at this time to sort of help with any sort of gaps in the capital stack.
I think they both said it very well in that, I think with disruption comes opportunity, and that's what we've seen for the PACE world in terms of it being a new sort of nuanced type of financing mechanism. Now it's become mainstream, to be honest. 4 years ago, 5 years ago, we would give a presentation on PACE and maybe 20% of the room even heard about PACE. Now we go into a presentation and 75, 80% of the room understands the PACE financing mechanism. And it all boils down to it's creative in nature in terms of the cap stack. When you can include 35% of your lending source into your cap stack, that's basically 10-year treasuries plus 300. You're at a coupon about 7.5. It works very well. So a lot of people are looking at this as an avenue to get their deals done. It all boils down to penciling out, getting your yield, etc. And PACE gets you over that threshold right now.
Absolutely. Mark, I'd love to hear from you. Do you have any thoughts on the importance of alternative financing methods or structures as we sort of head into 2026?
Olivia, that's out of my strike zone. I'm sorry. I can't help you with that. That's why you got Glenn and you got Doug, fortunately.
Awesome. No worries. Well, I will ask you about sort of the contraction of manufacturing and construction, which is one of the things that we've seen as of late. Do you think that opens up opportunities in any other areas for the real estate market in particular?
Well, I mean, when I think about the world, I think about it from like a 30,000 foot level. And when I see the weakening in construction activity and everywhere except for data centers, I mean, obviously the data centers are booming and anything AI related. But outside of that, construction activity is down in a meaningful way. We're just building less. And that in the near term is a reason for some nervousness about the economy because construction is a important part of economic activity. But it does, to your question about opportunity, it does help these markets normalize, meaning if you have problems with vacancy and rents are weak, the lack of construction obviously is going to help right the ship. And I think we're starting to see some of that in some of the markets. I mean, even in the office market, you've seen such a collapse or such a significant weakening in office construction in many markets across the country. It should start to now allow vacancy rates to kind of roll over and start to come down, even with weakened demand. So we're starting to see the seeds are being sown for I think a healthier commercial real estate market going forward just because of the lack of construction. We're not through the cycle yet. There's still more to go here, particularly given the weakened economy and the weakened demand absorption. But I do think if we can get through the next 6, 12, 18 months and look to the other side, the weaker construction does, along with at that point some improvement in demand, lays the kind of the foundation for a stronger commercial real estate market going forward. So it's going to be, again, I've used the word uncomfortable before. I'll use it again. It'll feel uncomfortable, I think, through the remainder of this year, through much of 2026. But when you look beyond that, it feels like we're starting to see the foundations for a recovery beginning to come together.
Yeah, normalization. That feels like a very important word right now because
Yeah, I'll take it.
we're all recovering from what was extremely abnormal for a couple years there with these, very low interest rates and tons of development happening. And I think now normal is good and it's what we all want. I have a final question for all of you. I'd love to start with Mark just because he gives us that higher level perspective. If you were advising a commercial real estate developer today, would your advice be to sort of double down on growth opportunities, pivot to the defense, or do the infamous sort of sit back and wait, which is what we hear from a lot of people right now? The kick the can to the next year, extend and pretend, all those fun sayings that have been kicked around. What would be your advice?
Well, of course, the obvious, Olivia. I mean, CRE decisions, investment decisions aren't made at the 30,000 foot level, right? I mean, it's location, the specific property type and location, and that matters, much more than anything else, I think, because I'm sure there's opportunity out there, even if you feel uncomfortable about the broader macro economy at the 30,000 foot level. But having said that, uh, there's a lot to work through here. The tariffs are still underway. The global trade flows are being significantly redirected as a result. Immigration policies are changing very significantly. That's going to have significant implications, going forward here. There's just a lot of kind of moving parts here, and in that kind of environment, my instinct would be to be cautious. Yeah, and if you find opportunity, great. And at some point you will. But I do think the next, as I said, 6, 12, 18 months are going to be tricky. And I think sitting on your hands might be the right strategy in general.
Doug, Glenn, do you guys agree? You think it's time to sit tight and be patient, or get out there
We sit here in
and
Dallas, and it's hard when you're in Dallas to think that
Right.
there's even a slowdown going on.
Exactly. Yeah.
But between, I mean, some of our comments today, jobs are slowing, immigration's, is definitely down. I mean, that drove a big part of our apartment absorption at near record levels over really, the last 3 years. And suddenly that no one really talks about that much, but that's it's like 30% of your apartment absorption that's being significantly constricted. And jobs drive a lot of demand. So there's a lot of concerns, when you get outside of Dallas, Texas. But we're not immune either. And as I talk to my institutional clients around the nation, I always just tell them follow the demographics and don't bet against demographics and follow the fundamentals. And you'll find opportunities. I think there will be opportunities, especially I'm working with some distressed debt groups, and they're excited about their opportunities for reasons that we don't want to be excited about necessarily, but there's crisis equals opportunity in some languages.
That's
So
right. Yep.
Yeah, Glenn, I
not
guess
suggesting
that's
a
the
crisis, by the way.
perfect way to end it, Glenn. Are we lucky to be in Texas, or
Oh
are
my
we
gosh, are
not
we
lucky to be?
lucky? Yeah, we are so lucky because we've had so much migration into Texas, and that's gas in the fuel tank for economic growth and development. And I think that, again, Doug said it best. We're not immune, but in terms of where I would like to place my money, Texas is doing very well. We've had a very much of a slowdown in terms of actual construction, comparatively speaking. When you look back historically, the numbers of developments occurring have really gone down uh, for Texans. I mean, literally, hey, you give us money, we'll build it, we'll spend it, but that hasn't been the case over the last few years. They put the brakes on, but having said that, I think there's some opportunities, especially in retail. I think that there's been a such a slowdown on new construction that there's opportunities there uh, for sure.
Well, that's very good. Of course, we hope that the nation as a whole is sort of moving into recovery phase. I know that it seems like, it might get a little worse before it gets better, but there's a light at the end of the tunnel. Is that fair, Mark?
Oh, there always is. I mean, what is it, the saying, don't bet against the American economy for sure. I mean, so yeah, I think there's a lot going right in the economy, and it's an amazing thing to watch. I mean, we've had our problems over the decades, and we've always overcome, and so I feel the same way. Don't bet against this economy. Even if there's some issues here in the near term, longer run, I feel very confident about our prospects.
Oh, I love that. It's lovely to end on an optimistic note. That's all we have time for today. I'm so grateful to all three of you for your insights. Thank you for sharing your time and expertise. As always, if anyone in the audience has questions regarding CPACE, please reach out to Lone Star Pace. And thank you all so much again for joining us.
Thank you.
Thank
Thank
you.
you.